I can tell you this with absolute certainty. The difference between profitable and unprofitable traders isn't technical, it's psychological. Every time you place a trade, you're literally fighting millions of years of evolutionary wiring. Your brain's limbic system, the ancient part responsible for survival, doesn't understand probabilities or expected value. It only knows threat versus safety. When a trade moves against you, your amygdala fires the same way as if a predator were chasing you. Stress hormones flood your system. Your prefrontal cortex, the part responsible for logical decision-making, goes offline. This is why even the most intelligent traders make seemingly irrational decisions under pressure. They're not stupid. They're human. They're fighting a war against their own biology every single time they click buy or sell. Let me share a story that illustrates this perfectly. A former NASA engineer with an IQ higher than most people's golf scores once told me about his worst trading day. He had a systematic strategy that had been profitable for 2 years. Clear rules, back-tested data, the works. But during a particularly volatile week, he watched his carefully planned position sizing go out the window. After 3 losing trades in a row, he doubled down on the 4th trade, then tripled down on the 5th. By the end of the week, he had blown through 6 months of profits because his caveman brain had taken control of his rocket scientist intellect. Understanding this neurological reality is crucial because it explains why discipline feels so unnatural. You're not fighting the market, you're fighting your own biology. The professionals who consistently profit have learned to work with their psychology, not against it. They've developed systems and rules that minimize the impact of emotional decision-making. They've turned discipline from a conscious effort into an unconscious habit. Risk management, the unsexy foundation of wealth. Let's talk about the most boring, most important topic in all of trading: risk management and position sizing. I know. This isn't the glamorous content you see on social media. You won't see any YouTube thumbnails with red arrows and shocked faces talking about proper portfolio heat calculations. But this unsexy topic is literally the difference between building generational wealth and joining the 80% of traders who lose money. Professional traders think in terms of risk-adjusted returns, not absolute returns. They obsess over something called the Sharpe ratio. Essentially, how much return you're getting per unit of risk taken. A 20% annual return with 40% drawdowns is far less impressive than a 15% annual return with 8% drawdowns, even though the first number is bigger. Here's the mathematical reality that will blow your mind. If you lose 50% of your account, you need a 100% gain just to break even. Lose 75%, you need a 300% return. Lose 90%, you need a 900% return to get back to even. This is why institutional traders are absolutely obsessed with drawdown control. Every single trade is sized based on portfolio heat, correlation exposure, and maximum acceptable loss. They're playing an entirely different game than retail traders who size positions based on gut feeling or how much money they made last week. Here's the discipline challenge that trips up most traders: maintaining consistent position sizing after wins. When you're up 20% for the month, every instinct in your body wants to press your advantage. You feel hot. You feel smart. You feel like you figured out the market's secret code. This is precisely when disciplined risk management becomes most critical. And it's precisely when most traders abandon it. The professionals I know often reduce their position sizes after big wins, not increase them. Why? Because they understand that hot streaks are statistical variance, not skill improvement. They know that the market has a way of humbling anyone who gets too confident, and they'd rather sacrifice some potential upside to protect their capital from the inevitable cold streak. Emotional regulation under market pressure. Trading psychology isn't just about controlling emotions. That's an oversimplification that misses the point. Emotions are information. Fear tells you about risk. Greed indicates opportunity. The skill isn't eliminating these feelings, it's interpreting and responding to them appropriately. Professional traders develop emotional awareness without emotional reactivity. They feel the fear when a position moves against them, but they don't let that fear override their exit strategy. They experience the greed when a trade runs in their favor, but they stick to their profit-taking plan. This emotional regulation is built through repetition and systematic process. It's why successful traders are fanatical about their pre-market routines, their journaling, and their post-trade analysis. These aren't just good habits, they're psychological training protocols. The goal isn't to become emotionally numb. That's actually counterproductive because emotions provide valuable information about risk and opportunity. The goal is to create enough psychological distance between stimulus and response that you can execute your plan regardless of how you feel in the moment. The compound effect of consistent execution. Here's where discipline really pays dividends. In the mathematics of compounding, small edges executed consistently over time produce extraordinary results. But this requires something most traders struggle with: patience. The retail trading culture celebrates home runs. The 500% day, the account doubling trade, the YOLO trade that pays off. But professional trading is about base hits. It's about grinding out consistent returns while managing downside risk. When you have the discipline to execute your edge repeatedly, taking every setup that meets your criteria, managing risk consistently, avoiding revenge trading, you allow the law of large numbers to work in your favor. Your win rate stabilizes around its expected value. Your risk-reward ratios become predictable. Your returns compound. The traders who blow up are usually the ones trying to hit home runs on every swing. They overtrade, over-leverage, and eventually hit the inevitable losing streak that wipes them out. The traders who build wealth are the ones with the discipline to play for consistent singles and doubles. Systematic approaches to behavioral consistency. Discipline isn't willpower. Willpower is finite and unreliable. Discipline is system design. It's creating processes that make good decisions automatic and bad decisions difficult. Professional trading operations run on checklists, not intuition. Before entering a trade, there's a systematic evaluation. Does this meet our setup criteria? What's our risk-reward ratio? How does this fit with our portfolio exposure? Where's our stop loss? Where's our profit target? This systematic approach removes discretionary decision-making from the emotional moment. By the time you're looking at an entry signal, the hard decisions have already been made during your critical planning phase. The same systematic approach applies to trade management. Your profit-taking strategy isn't decided in real time while watching P&L fluctuations. It's predetermined based on technical levels, volatility expectations, and risk management rules. This is why successful traders are often described as boring. They're not making exciting intuitive calls in the heat of battle. They're mechanically executing predetermined plans with robotic consistency. The learning curve from reactive to proactive trading. Most traders start reactive. They see a stock moving and jump on it. They read a news headline and make a trade based on their immediate emotional response. They feel FOMO when they see others making money and chase whatever's hot. This reactive approach keeps them perpetually behind the market, like trying to catch a bus that's already left the station. The evolution toward disciplined trading involves becoming proactive. Instead of reacting to price action, you're positioning for probable scenarios. Instead of being surprised by volatility, you're prepared for it. Instead of panicking during drawdowns, you're executing your recovery protocols. This shift from reactive to proactive trading is fundamentally about developing systems that account for uncertainty. You can't predict what the market will do, but you can prepare for what you'll do in various market scenarios. The discipline to prepare for multiple outcomes and execute the appropriate response based on what actually unfolds is what allows professional traders to profit in any market environment. They're not trying to predict the future. They're preparing for multiple possible futures, building trading psychology through process. The most successful traders treat psychology as seriously as they treat analysis. They understand that mindset work isn't soft science. It's the hardest part of the business and the most important. This means regular self-assessment. Successful traders ask themselves tough questions. What emotional patterns am I noticing in my trading? Where's my discipline breaking down? What situations consistently trigger my worst decisions? Am I executing my plan or just reacting to my P&L? It means building resilience through mental preparation. Before the markets open, professional traders engage in what sports psychologists call mental rehearsal. They visualize various scenarios. What will I do if this trade goes against me immediately? How will I respond if I have a big winner early in the day? What's my plan if today turns into a high volatility, news-driven environment? This isn't new age mumbo-jumbo. It's the same technique used by Olympic athletes, Navy SEALs, and emergency room surgeons. By mentally rehearsing high-stress scenarios when you're calm and rational, you're literally creating neural pathways that make appropriate responses more automatic when those scenarios actually occur. Most importantly, it means developing recovery protocols for when things go wrong, because they will go wrong. How do you handle a string of losses? What's your process for regaining confidence after a major drawdown? How do you prevent one bad trade from becoming 5 bad trades? The traders who last in this business aren't the ones who never make mistakes. They're the ones who have systematic approaches for dealing with mistakes when they happen. They treat psychological resilience like a muscle that needs to be trained regularly. The professional mindset, process over outcomes. Here's the mental shift that changes everything, measuring success by process execution, not by P&L. This sounds counterintuitive, but it's absolutely critical for long-term success. When you tie your self-worth to individual trade outcomes, you create a psychological environment where discipline becomes impossible. Good trades that lose money feel like failures. Bad trades that make money feel like successes. Your feedback loop gets completely distorted. Professional traders celebrate perfect execution of losing trades. They're disappointed by sloppy execution of winning trades. This process-focused mindset allows them to continuously improve their approach without getting emotionally hijacked by short-term results. The discipline to maintain this perspective, especially during losing streaks, is what allows institutional traders to compound returns over decades. They understand that individual trades are just data points in a much larger statistical sample. Risk psychology, understanding your capacity for loss. One of the most important and least discussed aspects of trading psychology is understanding your personal relationship with risk. This isn't just about how much money you can afford to lose, it's about how much emotional capital you can risk without compromising your decision-making ability. Everyone has a different psychological tolerance for drawdown. Some traders can watch their account drop 20% without losing sleep. Others start making irrational decisions after a 5% decline. Neither response is right or wrong, but you absolutely must know which type you are and size your risk accordingly. Here's the crucial insight. Your psychological comfort zone matters more than your financial comfort zone. If you're risking so much that losses cause physical stress, sleepless nights, relationship tension, or an inability to focus on other aspects of life, you've already violated the first rule of sustainable trading. This is why position sizing is ultimately a psychological decision, not just a mathematical one. The optimal position size based on the Kelly criterion or other quantitative models is meaningless if it causes you to deviate from your strategy due to emotional stress. I learned this lesson the hard way early in my career. I had calculated that I could afford to risk 10% of my account on a particular high-conviction trade. Mathematically, it made sense. I had 6 months of living expenses saved, stable income from other sources, and a trading strategy with a positive expected value. But when that trade moved against me and I was facing a 7% account drawdown, I discovered something about myself. I couldn't sleep. I was checking the position every few minutes. I was irritable with my family. I was compromising my decision-making ability in other areas of my life. The position size that was financially appropriate was psychologically inappropriate for me. I learned that my optimal risk per trade wasn't determined by my bank account. It was determined by my stress tolerance. This self-awareness is crucial because it affects every aspect of your trading. If you're constantly operating outside your psychological comfort zone, you'll eventually make emotional decisions that destroy your edge. The discipline to trade within your comfort zone, even if it means giving up some theoretical profit, is what allows for long-term consistency. Advanced discipline, managing success. How many times have you given back your profits after a big winning streak? Success breeds overconfidence. You start believing you can predict the market better than you actually can. You begin taking larger risks because you're on fire. You start trading outside your proven setups because everything you touch turns to gold. The discipline to maintain your process during hot streaks is just as important as maintaining it during cold streaks. Professional traders often reduce their position sizes after big wins, not increase them. This seems counterintuitive. Why not press your advantage when you're hot? Because they understand that hot streaks are statistical variance, not permanent skill improvement. They know that overconfidence after wins leads to the same poor decisions as desperation after losses. The pattern is incredibly common. Big wins lead to overconfidence. Overconfidence leads to increased risk-taking. Increased risk-taking eventually leads to big losses. It's a psychological trap that catches even experienced traders. The discipline to treat wins and losses with equal emotional neutrality is perhaps the highest level of trading psychology. It's what allows truly elite traders to compound returns over decades without blowing up. They understand that both wins and losses are just data points in a larger statistical sample, and they don't let either distract them from executing their process. The long game. Building a trading career. Most people approach trading like buying a lottery ticket. They're looking for the big score that changes everything overnight. They want to turn $10,000 into $100,000 in 6 months. They're attracted to stories of day traders making thousands in a single session. Professional traders approach trading like building a business. It's about creating systems, managing risk, building relationships, and playing for longevity. It's about compound growth over years and decades, not explosive growth over weeks and months. This long-term perspective fundamentally changes how you think about individual trades. When you're building a 20-year track record, no single trade matters that much. A bad day doesn't derail your career. A good day doesn't make you successful. This reduces the emotional intensity around each decision and makes discipline easier to maintain. The discipline to focus on process improvement rather than short-term profits is what separates career traders from gamblers. It's why institutional traders often have modest daily P&L targets but exceptional long-term returns. They're not trying to get rich quick. They're trying to get rich reliably. Building this long-term mindset requires accepting that trading success is measured in years and decades, not days and weeks. It's perhaps the most difficult psychological adjustment for new traders because it requires patience in a culture that celebrates instant gratification. But here's the payoff. When you start thinking in decades instead of days, your decision-making becomes incredibly clear. Risky trades that might pay off spectacularly in the short term become obviously bad decisions when viewed through a long-term lens. Conservative risk management that seems to limit short-term profits becomes obviously necessary when you're trying to compound wealth over 20 years. Conclusion: the discipline advantage. I can tell you with certainty, discipline isn't just important in trading. It's everything. Strategy gets you to the table, but discipline determines whether you leave with the chips or leave broke. The market is the ultimate teacher of human psychology. It will find every weakness in your mental game and exploit it ruthlessly. But it also rewards those who can maintain consistency under pressure. The discipline to stick to proven processes, manage risk systematically, and execute without emotional interference is the only sustainable edge in this business. Every successful trader I know has a different approach to markets. Some are trend followers. Others are mean reversion traders. Some use complex algorithms. Others rely on simple price action. But they all share one trait: unwavering discipline in their execution. The question isn't whether you have a profitable strategy. The question is whether you have the psychological framework to execute that strategy consistently over thousands of trades through multiple market cycles, despite the inevitable periods of doubt and drawdown. That framework is built through discipline, and discipline practiced consistently over time becomes the edge that compounds into extraordinary results. The choice is simple. You can keep searching for the perfect strategy, or you can start building the perfect mindset. One is a fantasy that leads nowhere. The other is a skill that leads to financial freedom. The market is waiting to teach you which path you'll choose.